Dow Theory is known as the Bible of technical analysis. Every beginner is told to memorize it. But be honest, why do you draw perfect market structures just like the textbooks, yet your account keeps losing money day after day? I am going to tear apart the rigid definitions of traditional Dow Theory. I will show you how to truly read market structure, how to see through the shark's intentions, and how to never become someone else's liquidity again. Let's start by forgetting the lengthy, cliché theories. We will only focus on the single core principle, primary trend and secondary trend. In modern practical trading language, we call it impulse wave and pullback, or correction. Books teach that an uptrend is formed and confirmed when price continuously creates higher highs, HH, and higher lows, HLL. And this trend only reverses when the most recent higher low HL is broken. Sounds incredibly logical, right? But this is the graveyard for novice traders. Look at this real XAUUSD chart. Let's assume this is the last higher low, HLO. According to the book, you must wait for the price to pierce this low before shifting to a bearish sell bias. But look at how huge the distance is from the absolute top down to this low. If you patiently wait for the price to break this low before realizing the market has reversed, then I'm sorry, you arrived at the party when it's over. The sharks have completely taken profits on their short positions, and the moment you jump in to sell, the price spikes back up to hunt your stop loss. You are always the slowest one. So, what is the solution? How do you catch tops and bottoms like a true sniper? The secret lies in two words: momentum shift and multi-time frame analysis. Stop being a soulless peak and trough counting machine. The most important question you must ask your chart at any given moment is not where are the highs and lows, but rather, right now, who is in control of the game, the bulls or the bears? Look at the steepness of the candles, the size of the candle bodies to feel the power. Back to the XAUUSD example, on the H4 time frame, we have an exhausted uptrend. But instead of sitting and waiting on H4, we turn on our magnifying glass, zooming into the smaller time frame, H1 or M15. Look at this descending wave from the top. On the lower time frame, buyers attempt to push the price up to make a new high, but the candles are weak, full of upper wicks. Suddenly, boom! A massive red candle, solid body, high volume crashes down, completely shattering the short-term support structure. This is no accident. This is the smart money footprint. They are dumping aggressively. The microstructure is broken. Change of character? Regardless of H4 still being in an uptrend, on H1, the bears have roared, "We are in control." Now, what is your job? Absolutely do not chase the red candle to sell. Remember principle number one? Wait for the pullback. We will patiently wait for the price to retrace back to the supply zone or order block that originated that crashing candle. You can combine pulling the Fibonacci retracement tool to find the golden confluence at 0.5 to 0.618. When price taps into this supply zone, it prints a pin bar or a bearish engulfing candle. At this exact moment, you pull the short trigger. Stop loss is placed extremely safely and tightly just above the supply zone. Your take profit will aim straight down to that deep H4 low below. By trading the momentum shift on lower time frames, instead of waiting for the macro structure to break, you secure a trade with a risk-reward ratio of 1 to 5 or even 1:10. Risk $1 to make $10. That is how professional hedge funds make money. You don't guess the top, you follow the footprint of the one who created it. Very amazing, right? But the market isn't always trending clearly. There will be days you open your chart and it looks as terrible as a garbage dump. Let's move to a super difficult scenario, trading the sideway, choppy market, illustrated with the US 30 Dow Jones Index. When the price is pushed up, hitting the ceiling of the box, resistance, don't rush to sell immediately because it could be a fake breakout. Look closely at the price action at the ceiling. If price hits the top, creates a long rejection wick, and H1, M15 candles start forming lower highs, what is it telling you? It's saying, sellers are still defending this fortress fiercely. Buying pressure ran out of gas. The exact moment that tiny bullish structure snaps downwards, you trigger the sell order. Stop loss placed above the highest wick just formed. And where do you take profit? Take profit right at the bottom edge of the box. Don't be greedy. In a sideway market, this ping-pong strategy, sell the ceiling, buy the floor, is the most optimal. But remember, every box will eventually break. How do you know the market is about to genuinely break out, real breakout, and not pull a trap? fake out. The breakout scenario is where the most brutal traps are set. Millions of traders worldwide place buy-stop pending orders above this box ceiling. Sharks know this. They will push the price just slightly through the top, triggering all retail buy stops, then immediately yank the price back down with a massive dump candle. You lose money and feel completely furious. Never trade the breakout on the very first touch. Wait for the rejection of rejection or price compression right against the resistance build-up. What does that mean? If buyers are truly strong, when price approaches the ceiling, it won't bounce back down deeply. Instead, it sticks tightly to the resistance zone, forming higher lows pressing against the barrier. Candle ranges tighten, trading volume decreases. This is called the phenomenon of absorbing supply. At this point, sellers are like soldiers out of ammo. Suddenly, a brilliant green candle, fully solid body, Marubozu, with no upper wick, pierces the resistance, accompanied by an explosive volume bar shooting way higher than average. That is the confirmation signal. This breakout is real merchandise. You can ride the money flow the second this candle closes. When trading a real breakout, price moves at rocket speed because it triggers a chain reaction. Sellers hitting stop losses, buy to cover, combined with FOMO buyers jumping in. You will see profits surge in just a few candles. Ladies and gentlemen, technical knowledge only accounts for 20% of success. The remaining 80% lies in psychology and risk management. There will be many days you analyze everything perfectly, but the market throws out unexpected news, or an anomalous money flow makes the price move entirely against your prediction. That is why the stop loss is not the enemy. It is the shield protecting the life of your account. When placing a stop loss, don't just randomly put it a few pips below the nearest wick. Place your stop loss at a price level where, if the market reaches it, entirety of your previous scenario and structural analysis is completely wrong. Don't be afraid to be wrong. Professional traders are wrong very often, but when they are wrong, they lose 1%. When they are right, they make back 3%, 5%, 10%. That is mathematics, not gambling. And one final survival rule before we close out this video. There will be times you open your computer, scan through all time frames, but the chart is foggy, messy, and you feel doubtful and conflicted. Theory points one way, intuition tells another. Next, let's talk about the move to break even trap. Many of you learn the trick to drag your stop loss to break even just after the price moves a tiny bit to protect capital. Don't do that too early. Price always moves in waves. It needs room to breathe. If you move your stop loss to entry too early, a tiny market pullback will sweep you out, whipsawed right before it skyrockets to the moon. You don't lose money, but you lose your peace of mind and a golden opportunity. My rule? Only move your stop loss to entry if and only if the market has completed forming a new structure. For example, established a clear higher low and breaks the peak again. Then, I trail my SL below that new low, trailing stop. That is the scientifically sound way to manage stops. And the final secret in this masterclass? Trading timing, kill zones. Don't open your chart at 9 a.m., draw crazy analysis, and expect a magnificent breakout. Why? Because that is the Asian session. The Asian session has extremely low trading volume. Breakouts during the Asian session are 80% fakeouts due to institutional manipulation to trap liquidity. If you want to trade breakouts, wait for the moment. Volume wakes up. That is the London session, early afternoon, and New York session, evening. Thank you for being patient enough to reach the very end of this video. You have proven you possess the qualities of the 5% winning traders. Leave a comment, I am a sniper, below so we can recognize each other. Remember to hit subscribe and turn on the notification bell. Robert will continue to accompany you on the path to conquering financial freedom. Wishing you an explosive trading week. Goodbye and see you again.